Hey everyone, back again for another live edition here of That's Our Two Satoshis. I'm Jeff Dorman, Chief Investment Officer at Arca. For those new, we write a weekly blog every week for almost 5 years now, talking about market conditions in digital assets. Check it out on our blog at ar.ca. But what we do in this show is we kind of walk through, or in this case, I don't have a partner here with me today, walk through what's going on in the market, what we're seeing, and what we think is relevant. So the focus of this week's write-up was really, I sent a tweet, sort of a off-the-cuff tweet the other day, just saying if token holders were able to live stream the meetings that we're having with pensions, endowments, family offices, and other big institutional investors, no one would ever sell a token. I basically said the light bulb, goes on immediately every single meeting, and allocations are coming in pretty big size. So pretty bullish tweet without a lot of details, and the feedback from a lot of people was, what the hell are you talking about? Can you give me some details? What are you saying in these meetings? What are investors thinking? So we actually dedicated the entire blog to just that. But before we get into that, we'll talk a little bit about market conditions and what we're seeing in the market. And then I'll walk through some of the things that we are saying to investors that is basically triggering an aha moment that is getting new investors to understand what digital assets are and why they're so important. And in my opinion, why money is going to continue to pour into digital assets over the next few years here. So anybody who wants to can go to the blog and follow along. But here's what I'm thinking about the market for a second. So let's back up a second on and identify what's been happening this year. Digital assets really started to go down around November, December last year. But it took at least 2 months after digital assets started to decline before we started to see real weakness in the rest of the market. Meaning, equities did great through end of last year. Bond market really hadn't started to spiral out of control. But now, 2.5 months into the market here, you've got the NASDAQ down 20%. The 10-year Treasury just fell 5 points in the last 3 days alone. The Hang Seng, over in Asia last night was down 5%. Commodities have been all over the place, mostly higher, but even oil fell 30% over the last few days here. You're seeing massive moves in volatility, everything from the VIX, which measures equity volatility, to the MOVE index, which measures bond market volatility, to the CVIX, which is currency volatility. Everything is going crazy right now in traditional markets. There's real stress in the system. It's almost all being caused by geopolitical risks, right? Starting with inflation and central bank tightening. And then, of course, moving on to the war between Russia and Ukraine and everything that has spilled over from there. What's interesting, though, is digital assets really stopped falling around January 24th. So if you look at the week ending January 24th, that was a pretty awful week. I think Bitcoin, I think Ethereum was down, call it 30% that week. Most digital assets were down 30 to 50. Bitcoin itself was down about 16%. That was a pretty rough week for the markets. Since then, though, most of the digital asset market is really unchanged. Bitcoin's actually a little higher from the lows of January 24th. Ethereum is basically unchanged. There's been a couple of pockets of strength, things like Ripple or Luna, but for the most part, our market has done nothing. Even though the rest of the world has gotten worse since January 24th. We just mentioned bonds are down 5 points. Equities fell another 7%. Currencies are getting destroyed, led by the Russian ruble, and also the spillover into the euro. It's really been nothing but carnage, and yet digital assets have largely been unchanged, kind of holding on. So a lot of people look for, a capitulation event, and we can't go higher until we capitulate. I would argue we already did. January 24th was that week of capitulation. And now, like digital assets tend to do, they're starting to be a leading indicator that the worst is probably behind us and that there's some sort of a floor. What I think is most interesting, though, when you're thinking about how investors take a stance on this space, is you look for things that have high up capture and low down capture. High up capture means, how does it perform relative to something else when things are good? And down capture is how does it perform relative to other things when things are bad? You want investments that go up more than the market in good times and go down less than the market in bad times. So let's look at Bitcoin's returns for a second, just as a proxy. Both Bitcoin and the NASDAQ are both down about 20% year to date. But here are the returns from the last 3 years. Bitcoin has been up 93%, 300%, and 60% in each of the last 3 years. NASDAQ has been up 38%, 47%, and 26%. So basically what that means for investors is you get way more upside when things are good in Bitcoin, but you're getting the same downside when things are bad. That is the kind of data that leads to higher Sharpe ratios, higher Sortino ratios, higher risk-adjusted returns that ultimately give investors confidence to invest in a new asset class. So of course, a lot of what's happening right now is just relative value. How are certain assets performing relative to others? Because like we said, almost everything is down outside of gold and commodities this year. So you're looking for things that have some sort of pockets of relative strength. And again, since January 24th, the digital asset market has actually been a pretty safe place to be. And I think when you combine that with the growth potential, as well as all these things we're about to get into about what's resonating with institutional investors, I think it's very likely that the bottom is in for a lot of different assets and digital assets. So I come back to a few things here, right? Nobody has any clue what's going to happen with Russia and Ukraine. The war, being waged with monetary solutions from sanctions is obviously out of our control. What can we control here? What we can control is, do we invest in things that have good valuations, and where is the money going to go when all of this geopolitical risk finally kind of starts to slow down a little bit, right? You're not going to hold it in cash. We have, negative 7% real rates. For those who aren't familiar with what that means, that basically is just the inflation rate minus the 10-year Treasury, or sorry, the other way around, 10-year Treasury minus inflation rate. So we have negative 7% real rates because interest rates are basically at zero, even though inflation is now at 8%. That means holding cash is a terrible investment. That means holding bonds is a terrible investment because you are going to lose money, all else equal, owning those, just based on the inflation. Okay, well, where else can you invest? Well, historically, investors might look internationally. Well, that's been shut off right now. You can't invest in Russia right now if you're outside of Russia. It's very difficult to invest in, say, Asia right now with how they're responding to the war. It's very difficult to invest in Europe right now, given how much of Europe's economy is dependent on Russia and Ukraine. So that really only leaves a couple places, right? That leaves U.S. equities, that leaves U.S. real estate, and that leaves digital assets. So in my opinion, you're going to start to see a huge, huge, huge inflow of capital coming into those places. And it's a powder keg, right? Once that money comes in and the fears go away, you start to see real price increases. And if you look at what's happening right now, this is the fourth worst start to U.S. equities in history. The other three all ended in positive years for equities. And I think you're more likely to see something similar. And, by extension, I think digital assets probably follow the same fate. So let's get into what I tweeted and what institutional investors are thinking. So, again, I would encourage people to read this. We titled it "The Aha Moment for New Digital Asset Investors." But we mean exactly what we said here. If you had a chance to be in these meetings that we're having with pensions and endowments and sovereign wealth funds and family offices, you would honestly never sell a token because they're starting to get it, right? This used to be an industry that was all about just Bitcoin and cryptocurrency, but now it has so much more breadth, from different issuer types to different token types to different sectors. And the investors are doing the work, and they're starting to get it. So a couple of themes that, and I won't read verbatim here, I'll let people go to the blog and read it themselves, but a couple of themes that we really try to get across when we're having these meetings, right? Our job is to use analogies that make sense to traditional investors. It's to help them really understand the impact that digital assets have. And I think, we generally have really positive responses from these investors. It is not uncommon for them to literally have a aha moment in the meeting and be like, I finally get it. It's not uncommon for them to allocate very quickly after even just an initial meeting with us, because it really does make sense when you have the chance to explain it in an hour and a half or a 2-hour setting, which is what we do with these larger institutional investors. Excuse me. So the first thing we focus on is stakeholder alignment. The line I like to use is, digital assets are the greatest capital formation and customer bootstrapping mechanism that we've ever seen, and it fully aligns all stakeholders, from customers to founders to passive token holders. Some of you have probably heard me use this analogy in the past, but this is probably the number one factor that we use, is explaining how debt and equity really splits the world into your investors on one side and your customers on the other. But it does nothing to align those groups of people, right? Take McDonald's, for example. McDonald's shareholders, largely wealthy institutions, not really the clientele that actually eats at McDonald's. In fact, there's a very, very low overlap between customers of McDonald's and shareholders. As a result, there's always going to be a wealth inequality created by the success of McDonald's, and also a lack of alignment between McDonald's most important customers and McDonald's most important shareholders. You could do the same thing with just about any company, right? Look at DoorDash, look at Airbnb. The people who make these companies work are not the same ones who get financially rewarded when that company or project does well. What tokens are doing is it's bridging that gap. All of the customers, whether it's a customer of a decentralized exchange or a centralized exchange or a gaming app or a Web3 project, all of the customers or users are encouraged and incentivized to be token holders. And what that does is it sparks motivation to help the company or project succeed because you're being paid out for its success, right? That's what owning the token of these projects and companies is you're basically owning the quasi-equity of this business. What does this do? It creates full stakeholder alignment, sticky customers, and it turns everybody into an evangelist, right? If I was a giant McDonald's shareholder and I was also a giant McDonald's customer, I'm much more likely to go get all of my friends and family and everyone I know to go eat at McDonald's because I'm incentivized for doing so. That's what happens here in tokens is every customer becomes an evangelist, and that's why you see the fastest growing companies and projects in history in digital assets, because that evangelism and that alignment of interest really pays off. That's a point that immediately new investors to digital assets really start to glean on it. In fact, it's not uncommon for someone to say, you're starting to change the way I think about equity, right? What is equity? Equity is your claim on profits and cash flows. Well, that's great, but if all those claims on profits and cash flows have nothing to do with the core user and the core customer, you could argue that you're leaving a lot on the table. Whereas if you start to pay out some of those revenues and profits through dividends or pass through entities to your customers and your stakeholders, all of a sudden that really becomes the equity. In fact, I was in a meeting recently where somebody said to me, it's crazy that Disney doesn't understand that if Disney had a token and that token gave you benefits for Disney Plus and theme parks and all the other IP and content that Disney has, that token would be way bigger than the value of their equity. Maybe Disney doesn't see that yet, maybe they do, but eventually all companies and projects are going to recognize that the value of tokens is greater than the value of your debt and equity. The next thing we talk about with investors is token structure. We basically say a good token is a hybrid instrument. It's going to be part quasi-equity with real financial upside, and it's going to be part utility or member benefit or loyalty program. The analogy I always like to use is imagine if Amazon Prime and Amazon shares were one thing, right? So on the member benefit side, you get all the benefits of Amazon. You get your free shipping, your Whole Foods discounts, your movies, your music. But on the financial side, you get some sort of a kickback for the increased revenues and profits of the business. Again, instead of the way it is now, where you could be an Amazon shareholder but not be a Prime member, or you could be a Prime member and not be an Amazon shareholder. So who did this perfectly? The example we always give is Binance, right? Binance with the BNB token. There's a reason that Binance is now a $300 billion enterprise value company. And when you combine the $70 billion token market cap with the couple $100 billion equity market cap that they have, there's a reason that happened, and it's because Binance did exactly what I just described with Amazon. They gave their tokens to their customers and said rewards or member benefits. You get discounts when you trade. You get to use our token as collateral if you do options or futures. You get first dibs on new IEOs that we bring on the platform. And then they even expanded outside of Binance and had some relationships with some travel agents around Asia. So that's your member benefit. That's your Amazon Prime. But then they also said, we're going to take 20% of profits and we're going to use it to buy back tokens. That's your financial incentive. The higher the revenues and profits of Binance go, the more tokens they're going to buy back. That increases the value per token that's left outstanding. By doing that, they effectively did what we just described with Amazon. They combined the Amazon shares with the Amazon Prime. They took their BNB token and said, you get a piece of our profits, but you also get all the member benefits. There is no reason why this can't be executed with every other company and project in the world. Take Soho House or Equinox or Netflix as example, right? These are all member models, but if they had a token so that their customers could participate in the upside of these businesses instead of just being customers, well, you can see where that would go, right? It would increase the customer stickiness, it would increase evangelism, and it would increase usage, and ultimately revenues and profits would grow. So you can have both equity and tokens on the cap structure because you are increasing the total pie of revenues and profits, even if you're dividending some of that out to your token holders. Again, this is a concept that immediately people in the room when we're talking to, they get it, They understand it. They say, how many different companies like this exist? Next, one of the things that we always talk about with regard to digital assets is the yields, right? Why are there higher yields in digital assets than there are in the traditional world, right? We have 0% Fed funds rate, we have 2% 10-year. Why are people talking about 8 to 15% yields in digital assets? Well, we describe this really easily. There's two reasons why yield exists. The first is because there's a shortage of working capital. If you're a market maker and you want to make markets across 20 different exchanges, from across the world, you maybe only want to make a market on 1 million Bitcoin. But to do that, you might need $10 million worth of Bitcoin to have markets across each of the exchanges, because you never know where the volume is going to be or where you're going to get hit or lifted. That working capital has to be funded by somebody. So those who have money can lend that out. And that is where the yields come from, is that there is capital, even though there's abundance of capital around the world right now. There was negative 1.6 trillion in reverse repo just last week alone. There's an abundance of cash on bank and brokerage balance sheets, but there's not a lot of cash in the digital asset ecosystem. And that shortage creates contango in options or in futures markets. It creates opportunities in the option market, and it creates lending opportunities. That's one place where yield comes from. The other is in the rewards. We already talked about how you can own this quasi-equity of a business in digital assets by owning their token. Well, a lot of these companies and projects will actually just give it away. And why? Well, you can go back to Facebook, 15, 17 years ago. Facebook was one of the first companies that used data to really understand what is it that makes our customers sticky. And they famously, you can look this up, but they famously realized that if we could get all of our customers to like 10 posts and to follow 10 friends within the first week of being on Facebook, that they had a very high retention rate. So everything that Facebook did from a growth hacking standpoint was designed to make their users do those two actions. But the customers didn't get paid for doing that, right? They were basically being tricked into doing that because Facebook knew that that would increase their revenue and profits. Well, turn that around to the token world. Well, now when these companies and projects know what actions do we want you to take? Do we want you to like or follow? Do we want you to deposit money into a DeFi protocol? Do we want you to play a certain number of games in your first week? Whatever action the company or project wants you to take, because they know that it will make you a sticky customer, they're paying you for doing so with yield farming, with new tokens. Those rewards generate yield for those who want to be active participants. So anyone who says these yields aren't sustainable, it's not true. These yields are sustainable as long as there is a working capital shortage, and as long as companies and projects are smart with regard to the rewards that they pay out. So next, we get into valuation, right? And this is this is where I think is probably the biggest sticking point with digital asset investors, and largely because they've been misguided by the media and by legacy crypto companies who focus exclusively on Bitcoin. There are a lot of different tokens in the market now, right? They're all different. Again, there's different issuers, there's different token types, there's different amortization and inflation schedules. There's different reward schedules, there's different sectors. They can all be valued differently. We at ARCA, we use traditional valuation techniques all the time. We use cash flow analysis, we use dividend yield models, we use relative value. You can go to a site like Token Terminal and look at the revenues and the cash flows of a business. Just a few weeks ago, we were on here on our That's Our Two Satoshis show talking about how we value layer one blockchains, both as businesses and as nations. Once we break down for investors that not everything is Dogecoin and Bitcoin, where it's a currency that has no real intrinsic value and no way to be valued, there are real businesses and projects with real revenues and real cash flows and real valuation techniques. Perhaps more importantly even is that unlike the debt and equity world where you have to wait 90 days to get a 10Q or a 10K and to get stale information, by the nature of blockchain being transparent, you can see these numbers in real time, right? We have real-time KPIs and dashboards for just about every company that we invest in the digital asset space, which means we know in real time, how their user growth is doing, how their revenues are performing, how their cash flows are doing. This is a real big advantage of digital assets over the debt and equity world. When you combine the data and information that you have in real time with these valuation techniques, you can come up with a price target for just about anything in the digital asset space outside of the cryptocurrency bucket. That means DeFi, layer one protocols, Web3, gaming, NFTs. You can come up with real values here. And we show these models every time we're in a meeting with investors. So what are some of the examples we use when we talk to investors? Because a lot of people like real world examples. We already mentioned Binance Coin, BNB. That's as simple of a model as you can put out there. It's just a buyback and burn model based on revenues and cash flows. We often use SushiSwap and Uniswap as examples because these are decentralized versions of the same thing Binance does, but they have clear revenues. And really it's a good kind of a stark example of what you can do with those cash flows, right? Uniswap does nothing with those cash flows. It all gets paid out to liquidity providers, and there's no value at all that accrues to the token. Whereas Sushi takes 5 bips of the 30 basis point fee and actually pays it out directly to token holders. So that's 2 examples of similar companies and projects, but one of them has a dividend turned on and the other one does not. We also use Nexus Mutual as an example. Nexus Mutual is a really easy business for people to understand. It's just a straight insurance business. The protocol makes money by taking in premium that's paid by those who want to be insured, and it loses money whenever it has to pay out a claim. Simple business, really easy. The capital pool is 2 times larger than the market cap of Nexus, meaning Nexus trades at 50% of book value. Again, whether you're bullish or not on any of the examples I'm giving, these are easy examples for traditional investors to understand because they look at them the same way they're looking at debt and equity. We often use Chili's, which is CHZ. That's the company that's underwriting fan token offerings. We use Axie Infinity because it's a real game that is tangible, that people can play, that has real revenues and cash flows. So you go down the list and we look for 1 or 2 examples in just about every sector that is easily explained through revenues and cash flows. And it helps investors understand why this business, why digital assets are real and why there's real valuation techniques that can be used. You probably noticed that I didn't mention Bitcoin very much in here, or Ethereum really. The reason doing so is that almost every digital asset investor comes through Bitcoin at some point in time, right? It's the first thing they ever heard about it. It's the first thing they owned. I love Bitcoin. Already on Twitter, people are saying that I hate Bitcoin because I wrote that we don't talk about Bitcoin to investors. Nothing could be further from the truth. I think Bitcoin is great. I just don't think it can be valued. I think it's a call option on the decline of fiat. And that's really it. It's either worth 0 or it's worth, $10 trillion, and everything in between is just noise for, algos and quants to trade around. But there's no way to tell you that 30,000 Bitcoin is cheaper or more expensive than 50,000 Bitcoin or 5,000 Bitcoin. So what we do is we just don't talk about Bitcoin with investors, right? They already have preconceived notions of what it is. It's hard to value. It's hard to understand. It doesn't make a whole lot of sense. I often compare Bitcoin and Dogecoin to AMC and GameStop, which is, if every single new investor to the equity market, all they ever heard about was AMC and GameStop, they'd probably never invest in equities because they'd be like, well, this is crazy. These are 2 companies that are clearly overvalued. It makes no sense why they're trading where they are. I don't know why people on Reddit are driving these prices up. And therefore, I'm going to steer clear of the equity market. But that doesn't happen because in the equity market, people know that AMC and GameStop are anomalies, right? That's not the norm. The norm is real companies, real businesses, real cash flows, and investors do well if the company does well. They're willing to separate AMC and GameStop from the rest of the equity market. Well, the same thing now has to be true of things like Bitcoin and Dogecoin. You can like it, you can trade it, you can do whatever you want with it, but it's not representative of the rest of the digital asset market. Bitcoin and Dogecoin are anomalies. Granted, Bitcoin is first, it's the biggest, it might end up being the biggest forever, but it's not representative of the digital asset market. So we just steer clear of it altogether, and we focus on the taxonomy of digital assets, which includes all these other different pockets that we just mentioned. So when you start to draw real parallels to the debt and equity world, it helps these pensions and endowments and family offices and all these institutional investors who have been investing in real estate and debt and equities forever. It helps them anchor what digital assets really are and what they're worth. And that's why we have such a high success rate when we talk to digital investors. So inevitably, some of these explanations begin to really resonate. Though when it starts to resonate, they start to think about allocations. When you couple that with what's going on in the world right now, where, over the past 6 weeks, our society has basically discovered that money and stocks are no longer assets. They're just a liability owed to you by some bank or brokerage account that may or may not actually deliver. You start to realize that digital assets not only have real value and a real place in your portfolio, but it might actually be one of the safest places to invest right now. So anyway, we hope the sneak peek behind the curtain of what we do in our meetings with investors was helpful. Again, I encourage everyone to read the blog, share it, ask questions. We'd love to hear from you. But, that's our 2 Satoshis for this week, and we'll be back again next week. Thanks for listening.